you possibly tell us who is present today before we start, just so we're clear?
Yeah. So there's yourself, Don Raisin, as chair, and the members, we've got Pat Maloney, Roger Irving, Jeff Broadhead, Peter Fieldsend, and Lynn Robinson. I'm just seeing if anyone, and that's all we've got at the moment. Yeah.
Well, welcome to everyone.
Sorry, Chair, we've got Donna as well, Donna Ridland.
Donna as well.
Just joining.
Great.
Yeah.
Okay. Just to explain to everyone the reason and why this meeting's been held as it is. As you'll all know, the government has required committees to start to meet again together. However, pension boards are not committees of the council, and the National Scheme Advisory Board for England and Wales has issued a notification based on a QC's opinion, which of course is as I understand it, is a document which has legal force until otherwise challenged. And on the basis of that, they have said that it is not necessary for pension boards to meet in person. And therefore, it is possible to hold this meeting remotely. Now, the position at Merseyside is that we can hold meetings remotely, but only with the permission of the Director of Pensions after consultation with myself. And on this occasion, Peter and myself have decided that a remote meeting was still, we thought it was still appropriate. And I think the reason for that is there are still government restrictions in place, and therefore we're not fully opened up. What I would say is that both Peter and myself view remote meetings as the exception. And as I say in the board report, which will be considered later, we do not believe these to be a normal thing. And on normal occasions, we will meet directly. And it is my hope and Peter's hope that we meet personally in Liverpool in September. So if I can just make that clear to everyone, this is an exception, but it is a legally allowed exception on advice from the Scheme Advisory Board and also from the Director of Law and Administration of the Wirral Metropolitan Borough Council. With that, could we go on to it? Have any apologies, Pat?
Haven't had any, Chair, no.
The other thing I should say, by the way, is that I'm having to use a phone to phone in because my internet connection has failed here. So if you're wondering why you can't even see a blank out of me, that is the reason I'm using a mobile phone. So apologies for that. Have we any declarations of interest?
Chair, I'm not sure whether I need to, but I will declare a potential conflict of interest that I was elected to Liverpool City Council last month.
Well, I mean, I'd take advice on that. I can't imagine, Peter, that there is an issue. I've never seen anything in the terms of reference, and correct me, Peter, which prohibits a councillor from an authority serving on this, because Pat's not serving as a councillor, is he?
Certainly, I don't see there's any need to be concerned other than the fact that Pat's made that declaration. So we're aware of that. But thank you. Yeah.
I'd like to say that strictly on a non-partisan basis, and I'd say that whichever party you've been elected for, congratulations, and I'm sure that you will serve your constituents very well. So congratulations on that.
Thank you, John.
If we can move to the minutes, if I just say the page, if anyone has a comment or a clarification or a suggestion, please just shout up. Page 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. No one has any issues. Again, I'd like to thank Pat for the excellent minutes there. And when we meet in Liverpool, I'll sign in due course. Okay, that's great. So can we go to item 5, which is the annual audit plan, page 13?
Thank you, Chair.
This item is the external audit plan for Merseyside Pension Fund for the year ending the 31st of March 2021. Within the pack is a report prepared by Grant Thornton and presented to Pensions Committee last night. The document provides an overview of the plan, scope and timing of the statutory audit of the pension fund to those charged with governance. To summarise the report, the key message and the key headlines can be found on page 15 of the pack, and are that Grant Thornton have continued to hold regular meetings with fund officers during 2020-2021. Financial markets have recovered during the year, and the impacts of COVID on MPF is reported as the significant impact being on the fund valuations, lockdowns, and also remote working. In terms of timings for this year's accounts and audit, MHCLG have revised the publication date for the unaudited accounts to the 31st of July and the audited accounts to the 30th of September for the statement of accounts for 2020-2021. MPF have agreed to provide a copy of its financial statements to Grant Thornton at the end of June, which is a month earlier than the official publication date. Grant Thornton will commence their main audit work during July and report their findings in September to Pensions Committee, to Audit Risk Management Committee, as well as to Pension Board. So the significant risks that have been identified are detailed on page 17 of the pack and are fraud in revenue and expenditure recognition. This particular risk, however, is considered to not be significant for MPF. Second risk identified is management override of controls. It is presumed that the risk is present in all entities, and the audit will perform some work around journals to assess that risk. Valuation of direct property investments. This valuation represents a significant estimate in the financial statements, and due to its size and the numbers involved, it's considered to be a key risk. Valuation of level 3 investments, again, the nature of these assets and the size and the numbers involved, due to the lack of observable inputs in their valuations and the estimates used, it's considered to be a significant risk again. All the risks identified are generic risks that could relate to any LGPS pension fund. There are no particular risks that have been identified as MPF specific risks. Page 19 of the pack informs members that the Financial Reporting Council have issued an updated accounting standard, that's 540, in relation to estimates and related disclosures. And this links really to item 6 on the agenda. As part of this process, the auditor needs to gain an understanding of the role charged with governance around accounting for estimates, and to comply with this standard are requesting further information from both Management and Pensions Committee on this area, and I'll discuss further at the next item. Materiality levels can be found on page 23 and have been set at 87.7 million, and that's 0.9% of net assets as at 31st of January 21, and the trivial level has been set at 4.4 million. The fees are summarised on page 26 of the report. For the main audit work, the proposed fee is £46,249. Grant Thornton also charged for work undertaken for other employers in relation to their IS 19 work disclosure, and this fee is detailed as £12,250. That element of the fee will be recharged to those employers that request that work. Thank you, Chair. Happy to take any questions.
Thanks, Donna. Questions from members? Anyone got any questions?
Oh, Donna's got a hand up. I know you can't see that, but...
Thank you. I don't know, can anyone see me? No, I don't know what's gone wrong, but anyway, I can hear you now. But sorry, I'm just trying to get the report up. Is this the one that covers the? I was just going to ask a question about the property rental, or is this another later on report? I need to get the papers up, as I can't get them up at the moment.
It's property rental income is covered in, or property rental is covered in this agenda item and the next agenda item. So happy to take the question now or the next item.
Yeah, it was just a query really that, obviously with the pandemic, rentals have gone down. So I just wanted to understand, has there been a massive impact on the fund, and have you looked at reviewing the bad debt provision to cover that? So it was just like a general query on that, really.
Yes. So in terms of the rental income, as we all know, COVID-19 has had an impact, in particular for our properties in relation to the retail sector and leisure sector. The managing agent, CBRE, work alongside our property manager at the pension fund and are working closely with our tenants, trying to negotiate and collect the rent. Obviously, as part of year end, we always review any outstanding debtors, and we'll make an assessment whether there does need to be any credit loss adjustments on those for the provision, what used to be called the provision for bad debt. So we've done it along with general debtors and rental income, and yes, we have gone through on a property by property basis, working with the CBRE managing agents to make an assessment as potential at risk or sort of a provision for bad debt. Yes, that's correct. We have.
Oh, okay, thanks. And I was going to ask about the unquoted investments as well. Just so and so obviously it's difficult to get a valuation if they're unquoted. So I was just wondering, when you realise an investment, how close is it to the valuation? Do you understand? So say, for example, I don't know, you had £1 million and that's what you got the quote valuation as, and then say you disinvested. Is there any analysis of the value at disinvestment to the value that you actually record in the accounts? Just to see, to see how realistic those valuations are. Do you understand the question?
Yeah, Donna, if I can come in on that question. If we take property, for example, we have quarterly valuations of our property, although there's obviously the annual valuation is the one that's more significant. Really, it's, as you say, when we sell a property that we find out whether those values are realistic. Based on the most recent valuation, we've undertaken 2 sales in the last 12 months. One is a building property down, so an office property down in Weybridge, and then we've also sold a sort of logistics unit as well. And both disposals have been above the book value, but not significantly above. So, for example, the office property, I believe the valuation was £9.5 million, and the offer came in at about £9.75 million, and then there's been a bit of negotiation around that. But in both instances, the values have been not too far away from the final property proceeds. But I realise I haven't got specific figures to hand.
Yeah, no, I mean, I suppose that's the acid test, isn't it? Based on your valuations. So for the unquoted ones, did you do anything? Have you got any analysis around any unquoted investments that you've actually, realised you've ended? And do these unquoted investments bring in, what's their performance against, quoted investments? Oh, that
No, I'm very happy to respond to that. I mean, if one takes clearly there's private equity, there's infrastructure, there is private credit as well. These are all unquoted assets that are level 3 assets that are valued. And again, the other 3 assets I've mentioned are obviously audited by auditors that we would recognise, and those balance sheets are then used. So, for example, private equity, the British Venture Capital Association has a book which effectively has sort of best practice in terms of valuing private companies relative to their public market equivalents. So there is a high degree of review of these things. As Donna will confirm, we have an independent valuer, Savills, for our properties. And as I say, whether it's infrastructure or private equity, there are industry standards, industry bodies that oversee the valuation process that is used.
Okay, thank you. I'm just trying to understand the risk against return and understand that bit of it. But no, that's useful, Peter. Thank you.
And just to add to what Peter said is, these are asset classes that people do invest in. They do follow the laid down best practice guidance with regards to valuations. They are audited, and part of our review of producing financial statements and then gaining assurances around the valuations that we're putting in those in our financial statements is that checking, reviewing what the statements, what their statement of accounts are saying, what their auditors are saying, and trying to make that link between what the value of the fund is compared to the percentage and the value of what our piece of that valuation is. So there is a lot of due diligence and a lot of assurance work that we actually do as well as officers of the fund to try and gain assurances around the valuations that we are using.
Yeah. Okay, thanks for that. Thank you.
Any other questions? Donna, could I just ask, you referred to the Financial Reporting Council and new templates they put in place, new standard questions. Is this some sort of response to perhaps the the FRC's response to the failings of auditors elsewhere in the past?
Possibly. I mean, this links us into the next agenda item, which is item 6. But just to say, the new accounting standards, it's a revised one rather than a new one. These questions that are in item 6 on the agenda, they've always been asked of management. They've also been asked of the chair of audit and risk. So there's just been a different approach in previous years compared to this year. So previous years they would ask a set of questions to management, and they would ask a set of questions to the chair of audit and risk, and both of their responses would be used in the auditor's risk assessment. What's happened this time, it's a different approach, and it's in line with compliance with the revised accounting standards. And what it's actually doing is it's opening up a two-way communication between the external auditor and pensions committee, and it's formalising those questions that were asked in previous years. It's formalising it in a committee setting.
So in a sense, and this is an issue of national, and that national issue is not a Merseyside issue. Because,
no.
As I've understood it in the past, there's never been a problem with the accounts. I can see this year there's not a problem with the accounts. But basically what's happening, tell me if I'm wrong here, is that there is what you might call a more potentially robust audit framework being put in place nationally. Would that be correct?
Yes, so it's across the board, and it's a national approach for all auditors. They'll be doing it in slightly different ways in terms of that assurances, but it's gaining assurances from management, and those management responses being reviewed and endorsed by pensions committee, and giving them the opportunity to confirm whether their understanding. It's their understanding of the fund and the control processes and the oversight, as well as given an opportunity to make any further comments on the areas covered.
No, that's helpful, Donna. Thank you. Has anyone else got any questions for Donna on this particular report, or do we want to move on to?
Could I just come in, John?
Yeah, of course.
Sorry, it's Jeff.
Yeah. Jeff.
Donna, just a quick question. I don't know what the position is with Grant Thornton's contract with us in terms of how long it's got to run, but I know that there have been problems with across the public sector in terms of getting auditors to not only renew their contracts, but also to actually then find new auditors. What's the position in terms of Grant Thornton here? Are they secure for a few years, or are we in that position?
You'll have to let me come back to you on that one. The appointment of Grant Thornton, it's done by the audit office, and we fall under the Wirral Council. Wirral Council umbrella, so they've renewed under Wirral Council, which also means that they do ours. But I think it's a couple of years, certainly a couple of years. But I'll come back with confirmation if that's okay.
Thank you. Yes, thank you.
Anyone else? Any questions or comments for Donna? No. Okay. Can we go to number 6, which again is Donna, which is the actual statement of accounts?
Chair, could I just interrupt? And I don't know if you noticed, but Stephen Van Aronson has messaged to say he's having real problems linking in from home, so he'll try again. So he's not actually with us, but he's trying to link in.
Okay, no, that's good. I mean, you perhaps could let him know there's a phone option, which as well, if necessary, which is what I've had to revert to.
Okay.
Okay, so in terms of item 6, well, this is actually it's not the statement of accounts yet. They're currently being prepared, ready to go to audit. The item 6 is linked to what we've just been talking to, and the purpose of this report is to provide board members again with a copy of report presented to Pensions Committee last night in relation to the audit of the fund statement of accounts. So as part of the audit and the auditor's risk assessment, the auditor is required to make inquiries of Pensions Committee under that auditing standard we've just been discussing. So Grant Thornton have requested management to respond to a series of questions and to the responses to be reviewed and endorsed by Pensions Committee, and for Pensions Committee to confirm that the responses are consistent with their understanding of the fund and give an opportunity to make any further comments. So the completed questionnaire can be found on page 41 of the pack. Sorry, I'm getting some come back on. So the report was presented to Pensions Committee to support committee with their responsibilities in relation to financial reporting process, and to provide committee and the auditors with assurances that the fund has adequate processes and oversight in place to minimise the risk of error. The completed questionnaire provides members with an understanding of management processes and strengthens the fund's oversight in particular areas that could give significant impact upon the financial statements. There are 5 areas within the questionnaire. So general inquiries of management, fraud, laws and regulations, related parties, accounting estimates, and Pensions Committee were asked to review and endorse sponsors at its meeting last night, which it did, and I've brought this report to the board for noting. Thank you, Chair. Happy to answer any further questions.
Thank you, Donna. Is there any questions on this report? As I can't see you, just please shout up.
I've got
one. Correct, Chair. Oh, sorry, Pat.
Thanks, Peter. Just one question. On the training budget, it's on page 95. It's budgeted as 20,000 with 15,000.
I think you've moved on to a later report. I think Donna's still on report number 6.
Oh, sorry. I thought we were on to the budget.
I think we're
Apologies.
still on 6, Pat.
So we're not
Yes,
on the
perhaps we
budget
can take
yet.
that question
We're
later.
still on 6.
Okay, I'll hold my fire then. Apologies.
Okay, Pat. This isn't easy to do it this way. Has anyone got any questions for Don on number 6? And none coming up, is it?
No, it looks like
Okay.
none. I think we
None.
asked on 5.
Okay, so do we want to agree the recommendation? To note?
Yep, agreed.
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 Item 7, Yvonne's LGPS update.
Hi everybody. This report covers the McLeod remedy, along with industry-wide impact issuing the administration of the LGPS. Took this report to committee last night, and the recommendation was that they note the operational implications emerging from impending changes to the regulations and industry developments. The first section gives an update on McLeod, and as the government's response to the consultation is not expected till the end of the year, Luke Hall has issued a ministerial statement, and this outlines the high-level policy position for removing age discrimination, and the key changes are listed within paragraph 3.5 of my report. Primary legislation will be required to introduce these amendments, and MACLG will then publish the draft LGPS regulations that bring them into force later this year. This will allow leading to implement the McLeod provisions for the April 2023 effective date. Whilst we're awaiting regulations, funds officers have undertaken a project to identify finances. We are verifying. We're also working with Audit on bulk data extraction and tools, and we are the LGA Communications Working Group, and we're looking to develop standard communications for members right across the LGPS. Section 3.9 to 3.13 of the report refers to the cost management of the scheme and notes the statutory requirements to review the costs of the reform schemes to ensure they remain affordable to the taxpayers. As you are aware, there are 2 processes running in tandem: an employer cost cap determined by the Treasury and a future service cost cap process operated by the Scheme Advisory Board. The 2016 review was paused in 2019 due to the uncertainties associated with the McLeod judgment. Now the case has proceeded through the Court of Appeal and the government has accepted the need to remove age discrimination. The cost management process has restarted. Treasury has confirmed that the McLeod remedy will be taken into account, but if it does lead to a breach of the cost cap, a reduction to members' benefits won't be applied. The Scheme Advisory Board are still deliberating about their cost management process for the LGPS, and I think they're going to make an announcement later on in the summer. Moving to the final section of the report, that covers the Treasury's consultation on the age increase of the minimum pension age from 55 to 57. The fund response to the consultation is attached as an appendix to this report, and I did share my response with the chair of committee and also the chair of the local pension board. And the main point of concern is that this was going to be unpopular, as this will require employees to both work and lock money away for a longer period. That's a brief summary of my report. I'm happy to take any questions on any of the areas within the report. Thanks.
Hi, once Roger. Just if the cost management process is recommenced, have you got any idea of a timescale for that? Because as we're all aware, originally it was looking though there might be some improvement to member benefits before McLeod happened.
Yeah, it was supposed to take effect for the 2016 one, would have taken effect for the 2019 valuations. and it would have been, as you're aware, the change, the amendments to the regulations was taken effect from the 2019 valuation. It was all paused. So I would imagine the Treasury have said in relation to their cost management, which is the overriding process, that if cost of the ceilings are breached by 2%, well, they're not going to change anything to the members' benefits. I would imagine it will come in. My sense is that it'll probably be from the next valuation. Will probably come in from the 2022 valuation. If there's going to be any changes, but I think I'll be waiting until then. We'll wait until the Scheme Advisory Board decides whether they're going to implement their cost management process or whether they're just going to wait for the 2%, because the Scheme Advisory Board is they can amend the scheme rules if there's any changes between the cost cap between 1% and 2%. So it remains to be seen what they're going to do. Whether they are going to implement anything that falls in between the 1% and 2%, or they will just go with the Treasury's cost cap mechanism, which says, you know, it's got to be 2% before anything changes. They're actually also guards have been looking at the process because they've got some issues with the mechanism that didn't really ring true. Because as you know, with the unfunded schemes, although they were saying the scheme wasn't costing as much for members, they were actually going to put the contribution rate up for the employers, because the contribution rate for the unfunded schemes are dependent on the SCAPE rate, the SCAPE discount rate, and that discount rate had fallen, which meant that the employer contributions were going to go about 2 or 3%, which was a bit asymmetrical, because to say in one breath you've got to pay more money, but the employer, you're paying more money, but the actual costs of the scheme are less. So we're going to put member benefits up. So they've just reviewed the process and regards of issues with report. We're saying they should be maybe looking at tweaks, maybe around the issue around longevity and whether discount rate impact should be taken into account also into the process for employer costs. So lots of things to be going on at the moment, but I would think it'd probably come out in the 22 valuation in relation to the results from the 2019 cost cap. So watch this space.
Yeah, thanks, Yvonne. So basically, in summary, as everything to do with pensions, it's complicated.
Yeah. And as they weren't very happy with the 2016 mechanism anyhow, so they've reviewed it, and they have found flaws with that. So they're going to have a look at it's actually fit for purpose in relation to, you know, the SCAPE rate, and also when benefits look less, you know, that we're going to increase the cost for employers, but increase the returns for members, which is again going to increase the cost for employers. So it doesn't seem fair.
Okay, thanks, Yvonne.
Okay.
Anybody else got any questions?
Yeah, I've got a couple of questions, if that's okay.
Absolutely.
It's in relation to the change to the pension age from 55 to 57. Just wanted to comment that I thought it was the response in respect of the effective date being when the regulations come into force rather than the data consultation was helpful, because I think for recruiting new staff, if we're telling them the benefits of the scheme and referring back to it, like in say 6 months' time and referring back to a date in February, I think it adds a bit of confusion really to people about what we're actually telling them about the benefits of the pension scheme.
Yeah, it's nonsensical, that, isn't it? Yeah,
no.
You make a point, yeah.
Yeah. The other thing is, am I right in thinking this change is going to apply to all schemes, for example, teachers' pensions scheme as well, or is this just a change to local government, so teachers' pensions as well? All the public sector schemes.
It'll be private schemes, everything.
Right.
It'll go right across public sector, private schemes as well.
Okay. And in respect of the actuarial reduction tables for people who access the pensions before normal pension age, do we expect those actuarial table figures to change at all? as a result of this or not?
I don't think it's not my understanding that your actuarial reductions will change in relation to the increase in the pension age from 55 to 57. Obviously, if you can't access it till you're 57, the reductions aren't going to be as great, are they? But this won't drive the actuarial tables to change. Other things may drive that to change, but not this.
Right.
Like around when we were talking about the cost cap, that was one of the suggestions, that the actuarial reductions, if they were saying the cost of the scheme is less than they valued, that was one of the suggestions that they said we might reduce the percentage reductions if that comes to fruition. But I can't see it being as part of the increase from 55 to 57.
Okay, thank you.
Okay, thanks, Lynn. Any other questions to Donna? Sorry, to Yvonne.
Yeah, Yvonne, in terms of McLeod, have you done any analysis of what its likely cost would be?
Well, we know, not in pounds terms, but we do know that there's 34,000 people who will qualify for the protection. 22,000 of them are the active members. We've got 6,500 pensioners and 5,500 deferreds. In the LGPS, as you know, the underpin is an additional amount to the final salary benefits if the care benefit isn't as great. And if we think about the increase to the accrual rate from the final salary benefit scheme, it was a 60th, it's now gone to a 49th, which is a 22% increase in benefit accrual. And because of the demographics of our membership, it's very unlikely for that period from where the underpin applies from 14 to 2022, that many people are going to have an increase in their pay of greater than 50%. So it's very unlikely that the underpin is going to kick in for many of our members. So I doubt that it's going to create any financial burden on the fund. Very little.
Oh, okay, thank you.
The public service schemes, the other schemes where the membership are staying in the former schemes, so there may be a bit more of a cost on the other unfunded schemes because they actually stay. The default option is for them, the default position is for them to stay in the old scheme. So there may be more costs for them schemes, but not for the LGPS. There'll be, I see it as a very limited risk that there's going to be additional costs to many of these within the fund.
Oh, thanks, Yvonne. Thank you.
Could I just raise one point, which is it's only 11 years since the minimum age was raised from 50 to 55. So putting it in context, that's an additional 2 years is very significant for people who are currently in the early 50s. I mean, it's a date I remember because it was actually it became effective on my 50th birthday. But I think it's a point worthy of note anyway.
They're trying to align the minimum pension age broadly with the state pension age. So, state pension age for a lot of people now is 67. So that's what the policy intent is meant to achieve.
Yvonne,
thanks.
Sorry. Just one more thing. Just on that, if this goes through following the consultation, do you think then that they would build in something to align it so that there's no need to consult on it again? So, for example, if state pension age changes again, would the LGPS scheme or national schemes automatically increase in line with that?
I didn't see anything put in the consultation saying that it'd be automatically linked. So I think they'd have to consult again. As what I've seen in the consultation, there was no indication or proposal for it to be automatically linked. So they would have to consult again.
Okay, thank you.
I was going to just ask you, Yvonne, in terms of Luke Hall's announcement, which you referred to at section 3.5, could you just outline to us how much that corresponds with the broad principles of the consultation last October? Remember the very long consultation of October?
Very much reflects what was in the high-level consultation. If you remember, the consultation was really extremely detailed, so it was our view that a lot of thought had gone into it, a lot of negotiations or talk with the union. So what's come out actually in the high-level position really does reflect what's in the consultation. There was no surprises in there whatsoever. That's fully what I expected to come out of that high-level position.
Thanks, Yvonne. Has anybody else got any thoughts or comments? Okay, I've just got one comment to make, which I do make this comment later on in my board review, but at the moment that's in the exempt. So I'd just like to say this in the public domain. Yvonne referred earlier to consulting with the chair of the Pensions Committee and myself, and that's absolutely correct. She does consult with both Pat Cleary and myself prior to putting in consultations, but it isn't just prior to putting them in, it's some significant time in advance. And what does happen is that both Pat and myself have an opportunity to come back and make comments, which then Yvonne has a chance to consider and then put in or otherwise into the final response. So it is a genuine involvement of both the chair and myself. And I'd just like to make that very clear to the board, and for anybody who might be listening or observing this call, because there is a genuine three-way consultation between the officers, the Pensions Committee through the chair, and the board through myself in any consultation response. And I'd just like that to be in the minutes and on the record. Okay, if we're content with that item, can we move to the recommendation? Is everyone content to note the report?
Yeah.
Okay, that's great. Item 8, back to Donna Smith again.
Thank you, Chair. This report provides board members with a report that I presented to Pensions Committee last night. The purpose of the report was to request that committee members note and approve the outturn for the financial year 2020-2021 and the finalised budget for the financial year 21-22. The board will recall that I presented a paper in March on the budget, and I had previously taken to March Pensions Committee, and it was agreed within those papers to present a further report that presents the finalised figures for the financial year just gone, as well as a finalised budget for 21-22. So those figures that was reported back in March to committee and to board can be found as Appendix 2, which is page 97 of the pack. The actual outturn and for the last financial year and the finalised budget for this financial year can be found as Appendix 1 to the report, which is page 95 of the pack. So the actual outturn for the 2020-21 is 21.5 million, which is lower than the original approved budget of 23 million. The underspend is largely due to planned projects and areas of work that have been deferred to 21-22 as a result of the pandemic, and also some assumptions around staffing, which is what I reported back in March. But you can see those underspends in the employees and supplies sections within the report section. The 21-22 budget reported in March has been reviewed, and it remains the same as reported and approved in March. So the finalised 21-22 budget is 25.5 million. Thank you, Chair. Happy to take any questions.
Thanks, Donna. Questions to Donna?
I've got one, Chair, at the right time now. I noticed that the training budget is only 20,000, although for obvious reasons it was underspent 2021. But this seems very low. It's less than 0.5% or around 0.5% of the total and on costs bill. I was just wondering, is that a sort of expected figure, or am I misreading things here or misinterpreting?
No, so the 20,000 budget is an officer budget for training. We do a lot of it in-house training, but we also offer some professional courses. A number of people will be employed and they'll come with professional qualifications. But yes, that is 20,000. In terms of training for members and board members, that is captured within the conferences section within the supplies. So the 20,000 is just for officers.
Oh, thanks for clarifying that, Donna.
Okay, thanks, Donna. Any other questions, Donna?
Yeah, it's me, Donna, again. I was just going to ask, so the subscriptions look like they're 60 grand more than original budget. I'm just wondering, what was that?
It was an accrual that wasn't put through last year. Unfortunately, so it was an invoice that it was a late invoice that had arrived during 2021, but in relation to the previous year, and an accrual hadn't been put through to put it back into that year. So there was an underspend in that particular area for that amount the previous year.
Yeah, thanks. The other thing is, you know, you've had upfront payments from certain authorities, so that's why the income is higher. Have you done any analysis of what the impact is going forward and what the next 2 years is going to look like?
Well, the contributions received, so I think the contributions received for 2021 is the higher figure because people have paid up front. Yeah. So there's an estimate there on Appendix 1 that contributions received, the projection for 21 to 22 is around the 172 million across all employers. And that's normally steady for the 2 years.
Right. All right. Thanks, Donna.
Okay. Thanks for that, Donna times 2. Any other questions? No. So are we content to agree the recommendation?
Yeah.
Yeah. Agreed.
Thank you. To move on to item 9, bond review.
This report reminds the board that we've got bonds in place for a number of our admitted bodies to cover their estimated termination debts. The bonds are reviewed on a triannual basis, and for the latest exercise, we've adopted a covenant-based risk-adjusted process for setting the bond level. And what we're trying to do, we're looking to achieve a balance between the risk on the fund and the burden of cost for an employer. The level of cover required is monitored, and employers are required to inform the fund of notifiable events in line with the termination policy to mitigate the risk of irrecoverable debt. Section 3.3 of the report notes that when an employer exits the fund without a guarantor, the exit debt is calculated based on assumptions consistent with the lower risk investment strategy. And if an employer can't pay their debt, then it would fall on the remaining employees unless there is scope to enter into a deferred debt agreement if the employer does actually remain solvent at the time. Under the new approach, each employer's covenant is being assessed as either strong, average or weak, and the bond has then been calculated based on a discount rate consistent with the covenant rating. Employers who are assessed as strong because they've either got a guarantee for another employer in the fund or a strong financial balance sheet, can obtain a lower bond than an employer assessed to have a weaker covenant. As a result, the bond is lower than the potential debt, as they should be able to pay some of their debt from any cash balances or any other assets they have. And for context, the liabilities for the funds at the 31st of December 2020 stood at 9.2 billion, and the termination debt in respect of further education bodies is 176 million. And as they don't have any bonds or guarantees available, the funds has previously stepped down the funding risk and allocated them to a medium risk bucket instead of being in the high risk bucket. And we've also reduced their deficit recovery period. If you look as well, the current level of cover for community admission bodies who do have bonds in place is 52.4 million. And after the review, the revised cover has been reassessed as 109.1 million. And this reflects the relevant covenant strengths of the employers, as the actual termination debt for these assessable employers is 192.8 million. And the increase from 52 to 109 is largely due to the fall in bond yields and the length of time since the existing bonds were put in place back in 2019. Since the existing bonds were put in place back in 2019, 2020. The fund is currently communicating the revised bonds to employers and will assist them with any queries that may arise because of your bond. Paragraph 3 put in place to minimise risks of irrecoverable debt arising from admitted bodies. Hopefully this report provides you with assurance that the fund is proactively managing employer risk, and I'm happy to take any questions on the report.
Okay, thanks for that, Yvonne. That was very helpful. Members' questions?
Yvonne, could I just come in? Sorry, it's Jeff. Where we changed the level of the bond because we assess their financial stability, is there not a risk that we, in effect, make them slightly higher risk because of where they are, and that in turn is like a downward spiral because suddenly they have to find a larger they have a larger hole to fill in terms of their liabilities, and that in turn can push them down that slope of becoming insolvent. Yeah. So almost it could be counterintuitive if we're not too careful in balancing this.
And that's why we need to make sure that we are monitoring the covenants, because we do get a lot of pushback from employers because they'll say, you're estimating your value and our covenant is really strong, but you're not taking account of that strength of covenant when you're asking us around the bonds. So it's around a negotiation with the employer, because some of these bonds have really increased by a great amount. And rather than just taking a strike date of when we do the calculation and we say this is the value of the bonds, things can change. I appreciate what you're saying. The covenants can change, but so can also the funding position and the unfunded debt. So we're just trying to get a fair, balanced approach to the employer and to the fund, making sure that the solvency of that employer isn't going to deteriorate by doing that extra monitoring. But it is really difficult when you're going to one employer and asking them to increase the bond level from maybe they had a bond for 15 million, then you're going and asking for a 25 million pound bond, especially in the current environment. It is really difficult. And the bonds that we've just started to go back and liaise with the employers at the moment. And I'm sure I'm going to be getting some further engagement from employers saying, we can't afford this at this point in time. So we've got to get to a mutual acceptable position for both the funds and the employer, because we don't want to put the employer under undue risk as well, pushing them into insolvency because we're asking for these huge bonds that they can't afford. So we've got to take a practical and pragmatic approach to it. But I do take your point that it is better for the fund if we just say, yeah, you've got to cover your full termination debt, but that's not the best approach for all our employers.
Yeah, no, I think what you've said is actually pretty much what I was hoping, which is that we are fairly pragmatic about this, that, you know, sometimes we have to understand the fuller circumstances rather than just apply a rule in, you know, in its strictest terms, because that would in effect be counterintuitive by almost driving people into insolvency. So thank you. Yeah,
we do have 3 different levels that the discount rate, and it is really robustly connected to the covenant strength.
Yeah, thanks, Yvonne.
Okay.
Thanks for that, Jeff. Thanks, Yvonne. Any more questions?
Chair, I've got one. In view of this, the bond yield volatility being so problematic, Yvonne, is there no better measure or proxy that could be used so it would be more stable both for us and also for the employers?
It's because if an employer exits the funds, they get put into a lower risk investment strategy to provide certainty that the amount of money that they're paying into us is then invested in a strategy that is pretty much matched along with investment risk, inflation risk, and interest rate risk. So the strategy where the liabilities are placed, the assets are really linked, a lot are linked to LDI, which a lot of gilts in there. So that is why we base the bonds on gilt yields, really. It's because of the lower risk strategy is basically against bonds and gilts. That makes sense.
It does. Is there an argument then to put to employers that bond yields are readily accessible, and therefore, if they're monitoring the state of their liabilities, there shouldn't be a sudden shock for them if they're being asked?
Yeah, that's true. And also there is, we have got a facility if employers want us to do that, but obviously it costs them, is that we will actually proactively monitor their funding position on a monthly basis. We have got a few employers who are actually on that route, on that path, because they're looking to exit the funds. So they're monitoring their debt. So when it's an opportune time for them to say, well, we can now lock into that lower risk bucket, we can take that certainty, we can leave the funds at this amount of this amount of debt, so we can lock in. So there is that facility for employers to monitor their funds and risk.
Okay, thanks, Yvonne. Thanks, Chair.
Okay. Thanks for that.
So just is employees trying to pull out of the fund? Is it a growing problem? Is it a significantly growing problem?
Well, for the community admission bodies, we've got about 30 community admission bodies, which the historic bodies, Roger, they wouldn't have come into the funds at today's. If they were looking for pension provision, they wouldn't come into the fund. These are historic bodies, and to be fair, they're only in because they can't afford to come out because of the termination debt. But new regulations came in last September with a bit of flexibility to allow employers to cap off future accrual rates, so they could either then enter into deferred debt agreements with us, which basically means they remain in the funds and they're just paying off the deficits. But to be able to enter into that, to them arrangements, they've got to prove to us, they've got to prove that they haven't got the money to pay the debts off up front. So there is the capacity now for employers to say, you know, and for these community admission bodies, we can't afford to carry on, the cost of, you know, the scheme is too great. So there is, you know, we want to basically exit, and can we come into a deferred debt arrangement with you? There's a facilities there. We have got a policy that allows them to do that, but it's a really, really strict policy that if they can show us that they can pay the debt off in full, we'll ask for that, because there's more risk in the funds, isn't it, keeping them in, that they could go insolvent down the line. So if we can get the money, all well and good, but there is that facility for them there. But yeah, you're absolutely right. We have got a number of employees that don't have to be in the funds because on a regulatory basis, because they're not tax raising, they're not Schedule 1 employees, so they're not under the regulations that they are. We are having conversations with a lot of employees about exiting the fund.
Okay, thanks again. Cheers.
Okay, thanks, Roger. Thanks, Yvonne. Any more questions? No, are we content to move to recommendation?
Yeah, agreed.
Agreed.
Yeah, agreed.
Thank you. Number 10, Northern LGPS update. Peter?
Yes, thank you, Chair. A fairly standing item, reporting the minutes of the February Northern LGPS Joint Committee meeting to the Pension Board. Happy to take any questions.
Any questions to Peter?
Chair, I've got one. Well, a couple. Page 114, and it talks about the MHCLG stated that there was 300 million in savings from lower investments and custody costs due to the greater scale. However, the transition costs were 270 million, leaving a 30 million saving. So I'm just to clarify, are those transition costs effectively a one-off, whereas that 30 million net saving should roll on year by year?
Yes, that's right. And to be clear, that's across the whole of the LGPS. So yes, the transition costs are mainly one-off, although they do include the establishment of the pooled vehicles, which have reasonably substantial ongoing running costs. But yes, the expectation is that cost savings will ratchet up quite quickly from here on in.
Oh, so that 30 million should increase?
Yes.
Right. Okay. Because I was going to say that if you look at the whole, the size of the entire number of funds, that 30 million is fairly small.
That's right. So, sorry, I'm just looking. Obviously, that's right. I was looking. There's a confusion between page 114 of the pack and page 114 of the PDF.
Yes. Sorry about that. Yes.
So yes, the expectation is that figure will continue to increase.
Right. Okay. And if I may, Chair, a couple of pages later on, it talks about benchmark costs from 2014-15 were 0.35%, and yet in 2019-20, LGPS Northern, that had gone up to 0.39%. The increase was apportioned to reflecting the increasing diversification of funds. Whereas, and I'm jumping on again, sorry about this, where it says the like-for-like 2019 was 0.5%, but the Northern LGPS had saved an effective 0.11%. So it actually outperformed the rest. But my point is there, if diversification has increased, and that's a benefit, obviously, diversification is seen to be, I've heard it described as the only free lunch in town. Yet, if the actual investment costs for a more diversified portfolio have risen by 0.04% for the Northern LGPS, and I couldn't work out from the figures what it was across the whole, across all of the LGPS funds, but obviously it has gone up. I'm surprised. I'd be interested to know what's the rationale for the increase in investment costs for a more diversified portfolio. Is that just because you're dealing with more investment managers? But wouldn't the increased pooling negated that negative effect?
You're absolutely right. It seems to be a paradox. It's because the diversification is into areas like infrastructure, which the government has been encouraging LGPS funds to invest in, and private market assets are much more expensive than public market assets, which is why on a kind of like-for-like basis, costs would have gone up by more than they have done, because, for example, with our GLIL infrastructure platform, we're investing more cost effectively into infrastructure, but nonetheless, the costs of that are higher than the equity or bond mandates that the funds have come from.
Okay, thanks for that, Peter.
Yeah.
Thanks, Pat. Thanks, Peter. Any more questions? Peter, I've got a question for you on page 115 of the pack. You talk about housing investment there, and you talk about the minutes say the office was particularly impressed with the fund's ESG credentials, and that's obviously very positive. But can you just assure us or otherwise that this investment actually met the actuarial assumptions of the Merseyside Fund?
Yes, I can give that assurance that clearly we look at the risk as well as the return, and this was viewed as a lower risk investment, and the return certainly met the actuarial hurdle that we've got, and we were comfortable with that it was a commercial return for the level of risk and the term of the investment.
So it was effectively a double win. It won on the primary objective, which is the investment risk, and it won on a secondary objective. I'll call it a secondary objective. That's not the official terminology, which would be the social, environmental, governance benefits.
That's right. So certainly for us, this sits within our, dare I call it, our fixed income allocation. So, a return of 6% with a degree of inflation linkage, is an attractive income for us relative to where bond yields are at the moment.
So very attractive, I think, return compared to bond yields. Have any other members any questions or comments?
I've got another one, Chair, if that's okay.
No, absolutely fine.
Thank you. Page 114, 116, section 30, update on responsible investments. It talks about that the IIGCC had invited all members to become signatories to a net zero commitment statement, it's said that GMPF was minded to become a signatory, and the committee discussed West Yorkshire and Merseyside individual positions on this. I wonder, what is the Merseyside position on this through you, Chair?
Yes, certainly. As perhaps the minutes confirm, we were happy to support that. We have an ambition, a stated ambition of being net zero aligned by 2050 with the Paris goals, and we were happy to support the proposal.
Thanks, Peter.
Any other questions to Peter? Are we content to agree the recommendation to note the minutes?
Yeah, agreed.
Yeah, agreed.
Item 11, the minutes of the working party, the governance and risk working party, I think is here, and also the investment management work. Oh no, it's the governance and risk working party. Does anyone any thoughts or observations on the governance and risk working party? Could I possibly then ask a question to Peter Stroker-Von? I noticed the admin KPI report, which comes here, was on that particular governance and risk working party. I noted, I think the last set of minutes before this that I saw, it was also on there. Can I therefore assume that now this report, i.e. Yvonne's report, which comes to the board, also now goes to the governance and risk working party?
Yes, that's right, Chair. Obviously, the board commissioned the admin KPI report, and I feel it's a very useful précis, really, of the administration side of the fund, and I think it's very worthwhile elected members receiving that report, as well as the regular updates they get at Pensions Committee.
No, thank you, but I mean, I would agree, because at the end of the day, it's the Pensions Committee that are the decision makers here, and they need to be fully aware of, you know, everything that's going on, and the fact that it's been put before the Governance and Risk Working Party, I think is absolutely appropriate, and that's very positive. Has anyone else got any comments before we move to the recommendation? Okay, can we note those minutes?
Agreed.
Okay. I think we now move to the exempt, so I shall read the declaration. At that point, if you're content, a member can propose, name themselves and propose it, and a member name themselves and second it, and then, well, if I can ask any member who disagrees to disagree at that stage, and then Pat can record what the decision is. So I'm going to read this declaration in full now. So I'm now proposing that we move into exempt business and that we exclude members of the public. The recommendation is as follows: that under section 100 (A) 4 of the Local Government Act 1972, the public be excluded from the meeting during consideration of the following items of business, which are listed below, on the grounds that they involve the likely disclosure of exempt information as defined by the relevant paragraphs of Part 1 of Schedule 12A (as amended) to the Act. The public interest test has been applied and favours exclusion. Could a member, if they're consented to do so, recommend that proposal?